All right. So the midterms behind us. Hopefully you all did well. You should have. I mean, if you looked at the review video, that should have helped. Like I said, questions should have not been any surprises. Opportunity cost, really key concept for personal finance, for life, for everything else. You know, if you do one thing, you forego another thing. So, you know, if you're spending all your money on bills and interest and stuff, you're not going to be able to spend it on other things. So sometimes, you know, life happens and you got to whatever, which brings us to retirement planning. Retirement planning, you know, as early as possible. These things all kind of go together because it's pretty scary. If you look at the nation's future in terms of what people have saved for retirement, you know, people have been through some fairly tough times and haven't put anything away. And maybe they haven't even done enough research into Social Security, or don't have Social Security or enough Social Security. But Social Security is not a lot of money. Hate to tell you. Okay, if spending exceeds the amount of your income, yep, you got to reduce it. You got to learn to live within your means. Liquid assets, liquid is cash. So obviously, by definition, cash is going to be the most liquid. Liability over a year. Yep, all these are over a year. People you owe money to, so people you owe liability long term since it's over a year. Best measure, net worth. So yeah, you can have a ton of stuff, but if it's all in debt, especially if it's depreciating assets, if you have a bunch of debt but it's stuff that appreciates, well, then that might actually build wealth. So you can't just look at somebody's debt and decide, oh, they're you know, they've got all this borrowed money. That's, and again, this is kind of, you know, advanced level stuff once your basic needs are met. But the wealthy get rich by not on their own money. They generally will borrow more money and leverage that. So anyway, important monitor debt level. Yep. Compound interest, we know all about that. So compound interest being a positive factor, money you have today is going to be acted on by compound interest. Couple questions on that. Compounding, earning interest on interest. Yep. Head of household, a special provision in the tax code. So you don't want to be single. I mean, I'm not talking lifestyle, whatever. I'm talking taxes. You're going to get, whatever, you're going to need some counseling after the IRS. It's not going to go well. You are going to be paying the highest amount. A homeowner, they really don't care. Although there are some provisions in the tax code that, you know, some things are deductible, mortgage interest and stuff. But your categories depend on your dependents. And if you're head of household, you're a single family member and you have dependents. So you get to file in that similar to a married category. So obviously you're single and a dependent. Simple math problem. No dividends even, so it's easier. Purchasing an item on credit. Home. This question may be changed. A provision in Trump's tax thing is to make some of this interest on consumer debt, all these other items, deductible again. It was back until like, I don't know, 80, 86, kind of before my time, certainly before just about everybody's time. But also reining in how much people can charge. So, free political announcement there. Financial institutions. Higher, that's how banks work, right? They take in money, they don't pay you a whole lot, and they loan it out. Sorry about that. I don't know what neurotic, I guess would be the best description for this pup. Anyway, your ability to cover short-term durations or deficiencies. Liquidity. Again, your ability to get cash. Disadvantage of using credit. Yeah, if you can't get it back, you know, to the credit company within 30 days, typically you're going to be paying some charges. Stop payment. Yep, can be useful. Not as useful as it once was, though, because checks aren't, you know, they don't have to physically be delivered anymore. It's all processed electronically. Overdraft protection, super important, super important. You know, if you bounce a check, that's obviously a little bit of a crime there. But then again, you don't want to have tons of money in your checking account to protect against, you know, bouncing a check, because it does nothing for you. So you're better off to have overdraft protection and keep that amount in your checking account relatively low. Again, it's not doing anything for you in there. Borrowing money for day-to-day expenses, yeah, it's a bad thing. You know, life is, you know, there are exceptions, but that's not, we're talking every day, and so that's not an exception. Pay off the balance every month, be a convenience user, certainly. Cash advances, they are not your friend. They charge you a fee up front typically, and then they charge you interest, and they charge you from that day one. You know, there is no grace period. So even if you pay it off at the end of the month, well, they're happy because they took whatever, 15, 20 days, whatever number of days you had that balance out there. Visa and MasterCard, kind of essential. I mean, not particularly those two, but well, it's kind of a monopoly, so probably one of those two. But life gets more expensive and is definitely harder if you don't have a credit card. That's just the way society's structured, and can be used for emergency funds, but only if you're not carrying a balance. If you're carrying a balance, then you have no place to put more charges. Finance charges, yep, you know about that. On the ones not due. APR, annual percentage rate, the only term that really matters. Credit card statements, always. Before, after, whatever. And if you wait for a paper bill, well, most of us, I think it's, you know, they certainly encourage you to go paperless. And the speed of delivery is obviously much faster to review those statements electronically. Collateral. Collateral is a good thing for both you and the lender. It gets you a lower interest rate, and the reason it gets you a lower interest rate is because the lender isn't experiencing as much risk. So they've got something they can reach out and take if the loan's not paid. Lowest interest rate is obviously, so collateral is what secures the loan. So those two are almost synonymous. Cosigner, bad thing. Don't do it. They will come after you, take your assets when the person who needed the cosigner, who by definition has crummy credit or no credit, can't pay the bill. Purchasing a home, real estate commissions are paid by the seller. So 6%. Pretty steep. You wonder why, especially in a lot of military up here. You know, military tend to move every 3 years, maybe a little longer. But anyway, when they buy a house for $300,000, they want to at least sell it for $318 because they want to pay that commission. They don't want to get stuck with that. So it is a bit of inflationary pressure up here. Homeowners Association, I could go on forever about. I don't like homeowners associations, but covenants, yeah, they can restrict how you decorate the thing, which, you know, is bad if you're the one who wants to do some sort of modest decorations, but you may have a different, you know, interpretation. And if you're the person who's living next door to the guy who literally, I think it was my grandmother, neighbor painted their house like this. It was kind of a purplish pink, fuchsia maybe. I don't know what the appropriate color would be, but it was pretty awful, and it became a landmark, and certainly didn't do anything for her own value. So a homeowners association might have prevented that. So it's a two-edged sword. Fixed mortgage remains constant. So there's a lot of moving parts when you get involved in this. You know, you can take say right now, because the interest rates are high, people are tempted to do adjustable mortgage, an ARM, and that's kind of cool because the interest rate is lower. The kind of not cool part is if the interest rates continue high or go higher, it can get kind of expensive. Anyway, it's definitely a gut check. You have to, anticipate which way the thing's going to go. And if that's not for you, the sleepless nights, you don't want to do that. You can hire maybe the higher interest rate, knowing that it's not going to change for the length of the loan. That might be a more comfortable way to go. Also, my daughter just bought a house like that, and they did do the fixed interest rate, but they fully intend to refinance, at the first opportunity. So the rates will have to come down at least a couple points to make it worth it. Usually it's 1 point just to cover the cost, because there's a whole bunch of new origination costs that start. So ARM, I just talked about that, adjustable rate. Insurance, ignoring risk, not a good idea. You have to acknowledge it, Avoid it, good, Don't do that. Don't, drive drunk. Don't do things like that. Accept risk. There's a bit of knowledge that you're saying, okay, I know what this is, but I can handle it. Insuring, transferring the risk basically to somebody else, but just pretend like it doesn't exist. That's never a good strategy. Comprehensive, so that's going to be everything else, the cats and dogs kind of stuff. Wind, hail, windshield, stuff like that. Deductible, how much you have to pay before the insurance company starts paying. Flood insurance, not really insurance, because everybody's going to be affected, everybody in the area. And so it would cause the insurance company to fail. And it's not like the insurance company pays everybody and then goes out of business. No, they go out of business. They keep all your previous premiums, and they, refile or reopen as another insurance company. And everybody who had a policy paid in all these years gets stuck. So the government knows that's going to happen. They won't even allow them to be in that business. Personal properties floater, could be a rider, could be an addendum. Anyway, it's just some way to delineate expensive items, specialty items, that will likely be excluded in a typical policy. You get a normal policy, if you read the fine print, you're going to realize that there's certain category limits typically for items. So, homeowners insurance, reduce it is increase the deductibles. Insurance is very frustrating. I had about $4,000 done to flooring in the home, and so I had my agent that I was able to call, and she said, okay, you can file a claim, but you do know that we're going to raise your rates, and within a couple of years. And basically it was like, why do I even have insurance with you? I mean, clearly they were going to get their money out of me one way or another. And anyway, I didn't file a claim. She won. And I switched insurance companies at the next opportunity. Not that the other insurance company is going to be better, but at least it's a faceless computer. I'm not actually listening to a person lecture me about how they got one over on me. Since health insurance is expensive, the employer and the employee. So, that's where most Americans get their health insurance. And it actually makes financial sense, because when you're a company, you've got a big group policy. And insurance companies are very, very nervous about when people approach them individually. I'll talk more about that. We're going to be talking about life insurance here in a second. But they're more comfortable with the group. What a segue. Life insurance. Okay, life insurance. I'll probably make a few enemies here, but I think I'm in fairly good company in terms of the people who have the opinion that I do. I will tell you that life insurance agents will, say what I'm saying is absolute, whatever. It's just the basic gist is from life insurance agents. They will do sort of a hybrid insurance investment thing, and their reasoning is that most people lack the discipline to invest, and so the fact that their investments don't yield very well, they don't really consider that, because they say people would not invest that money anyway. They would just blow that money on something, whereas I give you more credit than that. So there's very simple life insurance propositions out there, And then there's much more complex ones that, because they are more complex, they involve agents who have to sell you this to, get it done. And they're licensed and they get commissions forever. I've got a brother-in-law who's quite wealthy. He owns a winery and does some other stuff. And yeah, because he used to be an insurance guy, and his book, I guess they call it. Anyway, it pays him every time one of these people renew from years and years and years ago. So it's not a bad gig. If somebody's looking for a sales type position, you can make a fair amount of money. The problem is, where's that money coming from? And from a personal finance perspective, that would be you. So anyway, life insurance, we'll talk more. So just basic terms, provides a payment. You got to die. That's the problem here. That's the one thing that always kind of is bad about life insurance. In order to collect, you got to die. But this role of life insurance, maintain financial support for dependents. This leaving money for heirs, not so much. I mean, if you want to leave money for your heirs, you're way better off saving money, investing money, and generating money there. You put a certain amount of money in life insurance as an investment, a certain amount of money in a true investment, and that actual investment will just about in all cases just dwarf what the life insurance investment is paying. People don't like to talk about it. Yep. And people, realize they're going to need. Now, but the thing is, they make this case, if you listen to people, that, everybody needs life insurance. Absolutely not. If you're young, single, no dependents, you absolutely don't need life insurance. And if you're older, that ship has sailed. You don't need life insurance either. It's going to be super expensive if you did need it. But what is the purpose of the life insurance? Financial support for dependents. So your dependents, if you're older, your dependents are adults. You don't have to send them to college. You don't have to take care of them while they're growing up. That's happened. So anyway, role of life insurance companies. Help determine. That's a pretty generous definition. You don't say anything about extracting commissions. Okay, enough negativity. We're moving on. Applying for life insurance. Medical family history. This is pretty funny. One time I was flying fighters at the time. We were going off to fight, and I think it was Bosnia or something. It was one of these last minute things. And the chances of getting whacked were, fairly small. But just the same, they're out there. And I was in a need for life insurance. I had, I think, just one young daughter at that time, and a wife and all that kind of stuff. And I wanted to get loaded up with insurance. So I called a couple of these insurance companies, life insurance companies, and got a couple $1 million policies, which made them incredibly nervous because just some random guy out of the blue trying to establish multiple $1 million policies. They even sent a nurse to the house. I don't know if she's really a nurse. She at least, it's like Halloween dress-up kind of thing. And she drew some blood, but she was wearing one of those goofy little nurse hats. It was pretty funny. Anyway, but they wanted to do their homework because it just concerned them. That's why I'm saying if it was a group policy, they would have been, okay, this is reasonable. But somebody spending a lot of effort to seek out $1 million policy insurance, and the questions they were asking were just inane. They were like, do you scuba dive? Well, actually I do, but I wasn't scuba diving at that time, so I said no. And skydiving and all these other things that I wasn't actively involved in. They didn't say anything about it. Is there a war going on that you're going to next week? Nope, didn't come up, and I didn't offer it. Anyway, term insurance. So for 99% of the people, this is so simple and so easy and cheap. What you do is you are in a situation, you're young with a family, you got kids that are far from grown up, you'd like to give them the opportunity to go to college, you've got a spouse or some sort of significant other that may or may not be working, their lives are going to be greatly affected by you checking out. If you can mitigate that, the emotional thing, obviously for me it's not a big deal. Nobody's going to miss me too much. But the money-wise, they probably would have. And so that is under your power. You can control that. You can get that $1 million policy and get it done. And you just do a simple calculation and you say, okay, in this case, the wife's already working, but yeah, the salary is going to be diminished. We've got a home that's based upon 2 incomes. I've got, a kid or 2 that needs to, get through life and it'd be nice to have the mortgage paid off. It'd be nice to have money for college education. It'd be nice to provide a buffer on the income. So you do some sort of calculation, you come up with, I need about $1 million. And there you go. Now, you get that term policy and you say, okay, I need that for probably 15 years to get me through this. By that time, the home is almost paid off, so that's not going to be as expensive. The kids either did or did not go to college, so there's no money that needs to be set aside for that. And now, all of a sudden, you go to renew your term policy, and it's like quite expensive because you're closer to the end. You're maybe 50 or something, and they're going, people die, in your 30s, not very often. Although suicide and stuff like that, it is weird. The statistics are getting all screwed up now that people have other causes, but are more likely to have other causes. But anyway, it's a very simple calculation, super cheap. I mean, those $1 million policies, I think it was like in the $20 to $40 per month range. It wasn't a whole lot for what the benefit was. Now, if you look at a different type of policy, a whole life, universal life, all these different ones that have like a cash value, we're talking like $600-800 a month, something like that, which can be the equivalent policy. And so, no, I'd rather get the $40 or whatever and buy, $500 worth of stock. And by doing that, I ended up way ahead of where I would have been with some life insurance policy. So disadvantages. Yep, longer term, higher the premium. Yeah, they're making a longer bet. The older the policy, the closer you are to dying. Obviously, it's going to cost more for that. Premiums higher for males and females. Yeah, females don't tend to be loggers and roofers and other things that get them whacked, nor do they, hang out in bars and do stuff like that to the degree that males do. Males make sometimes bad decisions, and anyway, they end up dying a little quicker. Higher for smokers, fair enough. Medical problems, and man, they would love to know about those. So things like that, existing conditions, or even your DNA, you do want to kind of safeguard those, because in some cases that may make you uninsurable for a number of things. So how the premium, skyrockets. This person's about to die, or could die, 65. I'll make it a little longer. When they talk about life expectancy, it's kind of funny. People say, the life expectancy is about 70. But the truth is, if you make it to 60, 65, your life expectancy is out, 80-something. Because when they do that average life expectancy, they're looking at infant mortality and all these other things, drugs and suicide and all this other stuff. If you made it this far without doing any of that kind of behavior, you're in good shape, and you probably will make it well into your 80s. So, levels, yep. So none of this is anything other than what you would expect. Smokers are always going to be penalized, certainly. Yep. So there's different ways. They can say, okay, it's going to be $40 a month forever, for the length of the term. Although as you get older, the propensity to die is a little higher. So, you're going to get $1 million this year, but by the time you die, 20 years from now, you're only going to get, $400,000 or something. So that way your premium stays the same. Or you can say, whatever. There's lots of different ways. It's all marketing. Mortgage, life insurance. When you go to get, you'll see this often on credit cards as well. The mortgage companies will say, hey, we've got this great deal for you. We're going to enroll you in a life insurance policy at no cost to you. And since you've got the mortgage, if you happen to die, your mortgage is going to be paid off. So a couple things there. That's good to know because in your term life, how much you need calculation, well, you don't need to pay for the mortgage if it's already going to be paid for. And then the other thing is there is no free lunch here. The mortgage company, they act like, oh, this is at no cost to you. Somebody's paying for it. And the only person paying is me. So indirectly, you're paying for it. And a lot of it has to do with the fact that when you die, they're more concerned about their money getting paid off. So they act like it's a benefit for you, but it pays for them as well. Group term, obviously, again, group is always a good thing. Whole life, so permanent life insurance. These are things that are, again, this thing that I was referring to, where it's a hybrid type thing, where there's a investment component to it. And a salesman needs to explain this to you, and it's more of a program, and there's commissions to be paid. Term life insurance, you go online, you just fill that stuff out. Or, you could get it through an agent if you want, but it's not necessary. It's straightforward and simple enough that the law doesn't require that any agent be involved. But these ones are, they're sold to you as an investment, that there's going to be a cash value. When you hear people talking about cashing out their life insurance policy, you can't do that with term life because you didn't put money in there. These ones, though, they're not going to be in the same category. They're going to be literally 10 times more expensive. So you're tying up a lot of money, and a lot of that money is going to the salesman. Yep. So different types. So all these terms, you can just tell by the terms that they're using that they're not very self-explanatory. I guess whole life essentially tells you that it's going to be insurance for your entire life. Well, I don't know. Universal life, different life. Anyway, comparing it to term, much higher premiums, accumulate savings, and premiums remain constant. So yeah, it's going to be like a kind of a mortgage where the amounts stay constant. So now we go to variable. So universal, variable. I mean, they're just kind of throwing in adjectives here. The variable, what was happening is a lot of people were feeling that maybe they weren't get as much back from their investments. And because the insurance companies, by their nature, they have to be very conservative with their investments. And so variable gives them a chance to broaden out and maybe take some more aggressive investments, which are going to be inherently a little riskier. I mean, risk and reward are correlated. So, income method. So, determine the amount of insurance you need. This is silly. Income method. 10 times your annual income. Yeah. Are you living alone? Do you have a whole bunch of kids? Do you have a whole bunch of debt? Do you have... This is so easy as to the point of being basically useless. Budget method. This one, annual living expenses, special future expenses, debt, marketability. So this is a lot more comprehensive. This is kind of useful. So, I need $1 million because it's going to cost this much per year, and I'm contributing to this much. Future expenses, college. We've got a bunch of debt out there. I've got a stay-at-home spouse, so probably going to have to go back to work, but, might need some re-education. Not re-education, maybe just plain old education. And to get up to speed, to get in a good career. So you want something to go by. And then, obviously, if you're sitting on $1 million, hey, maybe you don't need a bunch of insurance. Using the internet. The internet is not some magic whatever. The internet will typically have these features in there. So The internet is just the mechanism of making it a little easier to calculate. Inflation, yep, debt level. So, you want to also calculate certain things like, future savings. Like our plan, if we were both together, this is again assuming this couple, and we're going to save up and, have this decent retirement with a vacation home, and if you calculate your insurance where that person is just kind of struggling to get by and is never going to be able to do a proper retirement, well, you might want to increase the amount of that amount of money you need in terms of that policy if you can afford it. So anyway, you can find lots of calculators to help you out on that. And again, the brokerage companies, they tend to have some of these products, or even on some of the big websites that compare these policies. And it's pretty competitive market out there, especially in term life insurance. There's certain companies too that rate the insurance companies that you want to look for. Anytime you're doing something in the financial business, there's generally a company, an independent company, and I'm not talking like J.D. Powers or something goofy. I mean, I'm talking legit, Standard & Poor's and Moody's and insurance. It's typically AM Best is a company that reviews stuff. Anyway, they verify the validity and the financial validity is probably not the correct term. The creditworthiness, financial stability. Anyway, make sure that the insurance company has the assets so that when you die at some point in the future, that company is solvent and there for you. Needs and dreams. Yep. So again, if you're getting term insurance, it's typically pretty damn affordable. And so I would maybe go more into the dream category. If it's the difference between $40 and $60 a month, yeah, splurge a little. Beneficiary, that's the person going to get it. Grace period, that applies to a lot of different insurance companies. And it can be used different ways, but grace period typically means that if you miss a few payments, there's a certain grace period. On the cash value policies, there's a certain number of missed payments before they take it. Living benefits, most policies have this feature now, where if you basically have a doctor's note that you've got a terminal illness, and let's say you've got $1 million coming, but you got to die to get it. Well, you and the family are struggling, and you're in that end of life situation. Perhaps they can, come forward with a little bit of that money so that you can not struggle towards the end and at least not have to worry about your finances if they know they're going to have to pay it anyway. Non-forfeiture clause. So again, a lot of different fine print on here. If you terminate that whole life policy, because again, you're investing and they're expecting their payment each time. If it has a cash value, yeah, you can typically take a loan against it. Incontestability clause, meaning certain things can be argued over and certain things cannot be contested. Renewability allows you to renew for another term once the policy expires. Typically, you want to look at a term policy and decide, how long you're going to need that coverage. How long? It's life insurance. If you think about it that way, that it's a temporary type situation. They call it life insurance, but you don't need it for your entire life. In fact, there's some things that are just grim, where they talk about life insurance for your newborn baby. What? I mean, if your child dies, there's nobody depending upon that child, and the last thing I want to do is, get a check because the bad news is it's grim. So the people who need the insurance are the parents. not the baby. Conversion policy, term and whole life. They always want you to go whole life. If you'll go on whole life, they will be more than happy. And then settlement options, like we talked about before, getting the money beforehand. Lump sum settlement and installment payments. So it could be, $1 million, or, like a lottery thing. We'll give you $100,000 for 10 years. Which one do you want? Well, obviously in that case you'd want the $1 million up front, but usually they'd sweeten it up a little bit. It'd be like $125,000 every year for 10 years, and you have to do a little math to decide what's a better deal for you. Interest payments. Yep. So, if you want to delay that. Selecting the life insurance company. So again, AM Best. So, if an insurance company, and if you're looking at a comparative website, they will have an AM Best rating, Mutual funds, Morningstar, stocks, Standard & Poor's or whoever, Moody's, but everybody's got their rating agency that's supposed to be independent. Investing fundamentals. So we're finally getting into actual investing. So we talked about, what to do to try and save money and all the rest of it. Now we're talking about what to do to try and make money. We'll only hit a brief overview as we'll spend more time on all these different categories. So the big thing about investing, if you still got credit card bills, pay off your credit card. You're not going to be able to make enough money in investing without taking significant risk. The credit card companies get such an exorbitant interest rate that you got to pay off your credit cards first and then start investing. Adequate liquidity, certainly. Yeah, you don't want to be that cash poor, but again, a little discipline. It's a better situation to be, not have any money because you're invested so deeply, rather than not having any money because you're paying all kinds of interest to people. Money market securities. Money market securities, things that are typically tied to the federal government, to investments, they're not going to pay much. They're not going to keep up with inflation. So they're more like a parking place to keep money. Stocks. So stocks represent an interest in a company. You actually have an ownership position. You also hear them referred to as equities. You own part of that company. Now, they're going to go through a big deal about common versus preferred stock. You don't really care, to tell you the truth. Number one, most stocks, at least all the stocks I've always made money in, and different people have different strategies, but typically if you're a younger person investing in general, you can accept a little bit more risk, okay? So stocks that you probably are interested in are more into the growth area. Growth stocks typically don't pay dividends because dividends represent a profit from the company. So a company makes some money and they have two choices. They can return those profits to the shareholders through dividends, or they can seek to grow the company by investing those properties or those profits into growth. And so when they start talking about dividends, companies I have, whatever, NVIDIA and some of these other ones that I've had for a long time, they're not paying dividends. They're growing. They're getting bigger. NVIDIA actually is getting to the point now where maybe they're going to start doing that. But anyway, so this whole common versus preferred stock, not a consideration for me. Also not a consideration is, let's say a company is paying dividends and all of a sudden they're in this situation where people who have common stock are not getting paid a dividend because the company's not doing that well, and only the preferred stockholders are getting the dividend. That's just not a company I want to be involved in. They're not doing well. They're I want to be involved in a company that's thriving, that's paying dividends to everybody, not under some sort of financial pressure. So, in all my years of investing, I've never come across a consideration between, preferred and second or common. Another thing, primary and secondary markets. They're getting kind of in the weeds here. It's transparent to most of us. Primary market is just not something that we get involved in, really. Primary means you're getting it from the company. No, most of the time, let's say you want to buy some stock in Ford. Unless you work for Ford or have some sort of special arrangement and are buying new Ford stock, that's not a common occurrence. If you go buy Ford stock, you buy it in the market. You're buying somebody's shares that are out there already. So that is the secondary market. Primary would be buying it directly from the company or perhaps some IPO. The problem with IPOs, initial public offerings, and you may be interested in participating in one of those, but I can pretty much promise you that you're not in a position to do so favorably. It gets kind of flaky. When a company is a private company and they decide they're going to go public, they're going to issue shares. So they've been privately held by, one guy or a small group of people, and they decide they're going to issue stock to generate money. They'll do an initial public offering. Well, they go with some bank, and the bank does the offer. Well, the bank offers those shares not to everybody. They offer those to their most selective clients. So you get in that day of the IPO, and those shares are probably already in the secondary market that you're buying, and they've probably already been inflated or deflated depending on the market. So if you're truly able to get in on the IPO and get those initial stocks, but it's not really a fair playing field. They don't offer those generally to retail investors. Retail investors are the guys like you and I that are not the big institutions, not the big corporate favored customers. So it's not exactly an even playing field. So secondary market is, whatever. NASDAQ, New York Stock Exchange, all these other things where the stocks are traded that are already in the market. One last thing on primary market and those kind of things. I did work for a company. I didn't really like this company, but they had a stock purchase program, employee stock purchase program, where they would sell me shares for a 5% discount, and they'd let me use, I think it was like maybe 10% of my salary to buy these shares. Well, I would buy them every time, the maximum, and I'd sell them the next day. That wasn't what they wanted. But, I just look at it as a way to make 5%. I would buy them for, I think his stuff was trading for $50 or something, so I'd sell it for, what would that be, $52.50 the next day, and I was making, I don't know how the math worked out. I calculated it was a little under $1,000 every year extra just by doing their employee stock purchase program. And so in that case, I actually was buying primary stock, but not for the reasons you would think. Types of investors, so they don't actually say retail. Retail investors are typically what you'll hear individual investors related to. So you've got institutional investors. Those are the big, companies, like it might be, a pension fund. When you think, oh, I work for, the teachers, well, the teachers of the state of Alaska or something like that, they've got people who manage those retirement funds for that, organization. Those are the institutional guys. Portfolio managers, these are the guys who work for big, maybe mutual fund companies or something like that, where they've got a bunch of stocks that they manage. And then individual investors or retail investors. Day traders, that's just a goofy, why they throw that in here, that does not make sense. Day trader is a specific kind of people who, and they're also mixing terms. Trading and investing are different things. Trading means you're just trading and you're trying to make money by trading. Investors it implies a little bit more of a long-term, more thought-out approach. These guys are like, oh, the price is up, the price is down. I'm going to jump in here, make a few pennies, get in and out, and in the same day. People in this can make a whole lot of money until they lose it all, and that's generally the case. People can convince themselves that they're the best day trader ever until they're not, and it's kind of funny. You have what they call a bear and a bull market. A bull market, kind of everybody's making money, and so day traders convinced that they've got this innate skill and they're really good at it until the market turns bearish, which means the market starts to turn south. And they try to do their same techniques and they end up getting wrecked. And anyway, but anyway, the big classes here: institutional, we can call that portfolio, and then retail or individual. So bonds are different than stocks. Stocks represented an equity position. You owned part of that. A bond is just debt. A bond is like a loan. So let's say you got a big company, they want to get bigger, they need some capital to expand. So they can sell shares and get some money that way, or they can get a loan. Well, you go to a bank, and you say, oh, we need millions of dollars. Banks at the big commercial level, that's not really where they work. They don't typically keep that kind of money around. No. What they do at that level is they organize a bond sale and they get money from investors. So if you buy a bond, you're making a loan. You don't have an ownership position. If that company fails, you're probably going to lose all your money. But you do have some recourse if they have some assets. If a stock, if you own stock in the company fails, you have no recourse. You own part of that company. It's not that company failed, it's your company failed. Stocks are direct ownership. And mutual funds, they kind of throw that in there. Mutual funds are typically invested in regular stocks. Most people are not so comfortable with that because you got to pick winners and losers, and it's just, for most investors, it doesn't make sense to hold individual companies. They'd rather have a little bit more diversification. So let's say you think whatever computer is going to do quite well, and so whatever you want to buy Dell or Apple or somebody like that, and you get to thinking about it, you go, I think computer's going to do well, but I'm not exactly sure what company is going to do well. Why don't I buy a mutual fund that has all those companies in it? Dell, Apple, HP, whoever else is making computers out there, and you own a little bit of all of these companies, and so you really don't care which company wins as long as that sector sort of goes, and that's a mutual fund within a sector. Or mutual funds can be arranged, however they want. However people will want to buy them, they'll try and tailor a product to make it marketable. So they may have mutual funds that concentrate on certain geographic regions. There may be mutual funds that say invest in Korea or the Pacific Rim. And if you try to go into those stock exchanges as an individual investor and try and buy those stocks, the regulatory, the currency you couldn't do it. But you can buy a mutual fund that has positions in all those companies, and then indirectly you have ownership. And so mutual funds are super popular and an easy and safer way to invest. And then publicly traded indices. Yep. So a lot of times on the mutual funds, they can also they can buy across a whole range of indices. Because right now I'm more involved in crypto, but I still want to be in the market, but I'm not that confident of my ability to pick individual companies. The one service I was using seems like it's failing lately. So plus other people maybe want to get lower expenses, so they'll buy across an entire Standard & Poor, in this case the SPY or the SP, the Spider, or the Got another one, it's QQQ, which is all NASDAQ. It's an interesting way to do it. It's super easy and it's super low expense, meaning it doesn't take a manager who's going to charge a lot to manage that fund because there's really no management required. Okay, and then real estate. Fantastic. So we'll talk more about that, but a lot of times, and I think I've mentioned this before, I try to make money in the market, and because the market is volatile, and I get in the most volatile of the companies, I try to get whatever profits and roll it into real estate, because real estate is much more stable, and also you can enjoy it. You know, looking at a huge balance, it's only interesting for so long. You know, living on some nice land and stuff is actually enjoyable. Returns from investing in stocks. So dividends and price appreciation. So as I said, you know, growth companies generally don't have dividends, but they do have price appreciation. So they're going to start defining these guys into categories. So substantial growth, income stock, income equals dividends. So in the form of large dividends. So now there's a lot more variations in stocks here, but that's one way. Bonds. So what you do with a bond is, let's say you want to invest in a bond. You give them $20,000, and they start giving you back whatever, a certain number of $1,000 per year for say 20 years, and then at the end of that, they give you your 20 grand back. So you get your interest payments, and then you get your money back at the end. And so that's how you make money on that. It's not going to be thousands of dollars; it's going to be, hundreds of dollars typically, and then your actual amount you spent on the bond back at the end. Now you can sell them before that, and we'll talk more about that later. But you don't have to keep it to maturity, but you can. And then mutual funds, just the same as having stocks. They can go up and down in value. And the way they do that is they calculate all the underlying shares and they determine the value. And they typically just do it, they call it a net asset value, and they typically only do that once a day, as opposed to stocks that are volatile and tracked real time. And then return from investing in real estate, rental income, and price appreciation. Rental income is only when your deadbeat tenant actually pays the rent. Got a bit of a situation there. So, again, you're not going to need to know formulas. I mean, this is not going to stick with you. What you need to know is, what they're showing you here, but this is intuitive. Price when sold, price when purchased. Yeah, I, bought it for $100, sold it for, well, actually, this is the other one. Yeah, price when purchased, sold it for $100, bought it for 80, made $20, yada yada, and you calculate a percentage. If there's a dividend paid, well, then you also made some money from the dividend. So you made your $20 plus whatever the dividend was each time. So you would add that on. Bond payments, talking about how it's going to be treated as ordinary income. Capital gains. So remember when we talked the same definition, 1 year versus over 1 year. So about 15% for long term, and whatever your tax rate is for short term typically. Yep. So it makes a difference. Investments risk. Yeah, standard deviation, subjective risk. So again, what you need to concern yourself with risk is risk versus return, or they should be correlated, and they typically are. What you don't want is you don't want something that's incredibly risky with a very low expected return. Not good. But again, the main thing with stocks, and this is, if you are going to be involved in riskier investments, you need to make sure that you've got kind of the wherewithal to stay in if the market goes out. Now, I'm not saying to chase things to the bottom, but if it's like anything, when people say, "Oh, the stock's way down today," I lost whatever amount of money. No, you didn't lose any money until you sell it. So you can look back at most stock crashes, and within a couple of years, the people are made whole again. They're back to their previous level. The stock market typically earns about 10% per year, which has been true since the turn of last century. Now, if you jump in and out at the wrong times, yeah, you can get clobbered. But if you don't panic, or you don't put yourself in a position where you have to panic and do some panic sell, then you're fine. This is why, for 99% of the people, you should not use borrowed money when investing in the stock market, because it can put you in those painful decisions. So, yep, small firms tend to have more growth but higher risk. IPOs, again, the way they're structured, it's just not a fair playing ground. I would stay away from IPOs for most people. And bonds, you have to look at the rating. There's some serious grade inflation in bond ratings. You get anything beyond, they're rated like with grade ratings, but they have like AAA rather than just single A, which means the scale is just skewed. Anything below a B is down almost into the junk range. Now, the person selling you the bond will talk about it being a high yield bond. But why is it paying such a high rate? Because they have to. Nobody's going to buy it. It's junk. Mutual funds, again, they can be comprised. You have to look at the underlying stocks. By definition, a mutual fund should be a little bit better because it's spread out amongst more companies, but you have to look at the underlying assets. And then real estate renters could default. Yep. Property values could decline. You could have both. You could have a renter who doesn't pay the bills and trashes the property. But anyway, we'll talk more about this in upcoming times. Realistic goals. We're not talking about crypto at all in here. Breaking my heart. Borrowing to invest. Yeah, not such a good idea. Taking risks to recover losses. Yeah. Doubling up to catch up. Not always working. And then the term project. We'll talk more about the term project next week. It's getting kind of long since we did the test review. But look through it. It's out there on the syllabus. And that's it.